The dark side of ETF hype, what you're not being told. Wall Street's new love affair with crypto. The headlines have been impossible to ignore. BlackRock, Fidelity, and other financial giants are suddenly embracing Bitcoin through spot ETFs. Financial media celebrates this as a new era for crypto. The influencers call it bullish. The public sees it as validation. But here's the question no one's asking. Why now? These same institutions once dismissed Bitcoin as speculative garbage. Now they're investing billions, filing ETF applications, and pushing Bitcoin into traditional portfolios. At first glance, it looks like progress. But in reality, this might be the most dangerous thing to happen to crypto in years. Because this isn't about access. It's about control. It's about shifting the narrative of crypto from empowerment to institutional monetization. In this video, we're going to expose the truth about ETF hype. What are you really buying when you invest in a Bitcoin ETF? Who benefits from this structure? And most importantly, how does it shift power away from the people and back to Wall Street? If you believe crypto was built to disrupt, not conform, you need to understand what's happening here. This is money-minded. Let's dive in. Chapter 1: The Illusion of Ownership. Let's start with the core question most investors never ask when buying a crypto ETF. What exactly do you own? When you buy a spot Bitcoin ETF, you don't own Bitcoin. You don't have private keys. You don't control a wallet. You can't transfer, spend, or interact with the blockchain directly. Instead, you own shares in a fund that might hold actual Bitcoin. But that Bitcoin is held by a custodian, typically a massive institution like Coinbase Custody or a bank, not by you. The fund structure, custody agreements, and operational processes are entirely opaque to retail investors. And yet, because the ETF trades on the stock exchange under a familiar ticker, investors feel like they're in crypto. They're not. This is the illusion of ownership, and it's one of the most dangerous traps in modern finance. Bitcoin was born from a philosophy of self-custody and decentralization. The whole point was to eliminate middlemen. You hold your keys. You hold your coins. You verify transactions yourself. No banks. No brokers. No institutions in between. An ETF destroys that model. It reintroduces all the layers of trust that Bitcoin was designed to eliminate. You trust the fund manager to buy and hold Bitcoin. You trust the custodian to secure it. You trust the auditors to verify holdings. And you trust the regulators not to interfere. That's a lot of trust in a system that crypto was meant to bypass entirely. And here's the irony: people buy ETFs thinking they're getting more safety. But in truth, they're giving up the very feature that made crypto revolutionary: sovereign ownership. Let's be clear, ETFs are not inherently evil. They can serve a purpose. They provide exposure. They allow traditional portfolios to allocate to crypto in tax-efficient, regulated ways. But they are not Bitcoin. They're a financial product built around Bitcoin, and that distinction matters. Because when things go wrong, when there's a regulatory freeze, a hack, a custodial mishap, or a liquidity event, ETF investors will be at the mercy of traditional systems. They won't be able to withdraw Bitcoin. They won't have access to the blockchain. They won't be protected by decentralization. They will be just like any other investor in any other financial product, waiting for lawyers, courts, and institutions to sort things out. What's worse is how this illusion of ownership is being marketed. Retail investors are bombarded with messages like, Now you can finally invest in Bitcoin safely. No need to learn wallets, just buy the ETF. Wall Street believes in crypto. But none of this has anything to do with what Bitcoin was meant to be. In fact, the ETF structure turns Bitcoin into exactly what its creator opposed, a black box asset controlled by a handful of powerful players who benefit from opacity and scale. Even more troubling is the behavior this illusion creates. Investors who own ETFs may never bother to learn how crypto works. They may never touch a wallet, never understand a seed phrase, never learn how to verify a transaction. They'll become passive consumers of a system they think they understand, but really don't. And over time, this erodes the educational, cultural, and financial foundation of the crypto ecosystem. It shifts power away from the people and back toward institutions. It strips away the core of crypto's mission. And it does so silently. Because illusions don't scream. They whisper. They reassure you. They say, don't worry, it's all handled. Until it isn't. Coming up in Chapter 2, we'll look at how ETFs are creating a new class of institutional custodians who now control an ever-growing share of Bitcoin, and why that poses a hidden threat to decentralization itself. If you find this content valuable, don't forget to like, share, and subscribe to Money Minded, where we bring clarity to the narratives others ignore. Shall I continue with Chapter 2? Chapter 2, The Rise of Institutional Custodians. Let's talk about what's really happening behind the curtain. ETFs have become the gateway for institutional adoption of crypto, but not in the way most people think. This isn't about banks and asset managers suddenly believing in decentralization or financial freedom. It's about control. It's about custody. Every ETF that buys Bitcoin has to store it somewhere. That somewhere is not your cold wallet, and it's definitely not decentralized. It's a corporate-controlled custody provider, often a single, centralized entity tasked with holding billions of dollars worth of Bitcoin on behalf of the fund. In most current spot ETFs, there's only one primary custodian. Coinbase, for instance, serves as the official custodian for multiple ETFs, including BlackRock's. That means a staggering amount of Bitcoin is being aggregated into a few vaults, controlled by a few hands, with little to no transparency for the retail investor. So what does that mean? It means decentralization is now an illusion. It means a handful of powerful players, BlackRock, Fidelity, Franklin Templeton, and their chosen custodians, are becoming some of the largest holders of Bitcoin in the world. And they're not holding it for ideological reasons. They're holding it for fees. Let's break that down. Every time someone buys shares in a Bitcoin ETF, the fund collects a fee, typically around 0.2% to 0.5% annually. That might sound small. But when billions of dollars are invested, it adds up fast. BlackRock doesn't care if you hold your ETF for the next decade. They make money whether Bitcoin goes up or down, as long as you stay in the product. The real game is about asset accumulation and asset control. In traditional finance, this is called AUM. Assets under management. The more AUM, the more fees. The more fees, the more leverage to influence the system. And here's where things get dangerous. Imagine a scenario where BlackRock, Fidelity, and a few others together control 10% to 20% of all circulating Bitcoin, all held in off-chain custody. Suddenly, these institutions become de facto governors of Bitcoin liquidity. They can influence market dynamics. They can lobby regulators with greater authority. They can sway public perception of Bitcoin's legitimacy. But it doesn't stop there. In future blockchain governance debates, especially around updates or soft forks, these centralized holders could become political entities within the ecosystem. They might not vote on chain, but their economic weight would make them impossible to ignore. They could pressure developers, sway mining operations, or even support network changes that favor compliance over openness, surveillance over privacy. That's not speculation. That's what power consolidation always leads to: influence, even if unofficial. And let's not forget, these same firms used to oppose crypto entirely. BlackRock's CEO once called Bitcoin an index of money laundering. Jamie Dimon called it a fraud. Fidelity was cautious for years. Now, they're building trading desks, ETF structures, and staking products, but only because they see a new market to monetize. They didn't change their values. They changed their strategy. Crypto is being reshaped into something that fits their business model, and millions of investors are helping them do it, unknowingly, by opting for the ease of ETF exposure over true ownership. Even worse, this new dynamic creates single points of failure. If a regulator, say the SEC or Treasury, decides to freeze assets or investigate a custodian, those Bitcoin holdings could be locked, restricted, or even seized. Retail investors who thought they had Bitcoin exposure might find their funds inaccessible, suspended, or under review. We've seen this in the past with traditional assets. ETF shares are not immune to liquidity crises, technical glitches, or custodial errors. And in a high-stakes scenario, like a market crash or regulatory panic, ETF holders will be the last in line to claim their assets. This isn't decentralization. It's re-centralization. The promise of crypto was to disintermediate trust, to give individuals power over their own wealth, and to eliminate the need for financial gatekeepers. ETFs are a return to those very gatekeepers, dressed in new branding. So while the headlines celebrate Wall Street's embrace of Bitcoin, the reality is that crypto is being boxed in, sanitized, and placed on a leash, one that institutions hold tightly. Coming up in Chapter 3, we'll explore the illusion of ETF-driven liquidity, and how it distorts crypto's market signals in ways most investors never see. If this opened your eyes, don't forget to like this video and subscribe to Money Minded for the insights mainstream media won't give you. Chapter 3, The Liquidity Mirage. Liquidity. It's one of the most used, and abused, terms in finance. With the rise of Bitcoin ETFs, analysts, media outlets, and fund managers all tout one major benefit: more liquidity. They promise tighter spreads, more volume, and greater access for institutional and retail investors alike. But what if that liquidity isn't what it seems? Let's pull back the curtain. ETF liquidity is not the same as on-chain liquidity. It doesn't come from people actually buying and selling Bitcoin on exchanges, transferring coins between wallets, or using BTC in real transactions. It comes from market makers, arbitrageurs, and authorized participants who are incentivized by fees, spread capture, and institutional mandates. In simple terms, ETF liquidity is a financial illusion, a layer built on top of Bitcoin, but not backed by real activity in the crypto ecosystem. Here's how it works. When you buy shares in a Bitcoin ETF, you're not causing Bitcoin itself to trade hands. You're just buying shares of a fund that holds Bitcoin. If there's enough demand, the fund may buy more Bitcoin to back new shares. But most of the time, the ETF share price floats independently of on-chain movements. And who steps in to keep the ETF price aligned with the underlying asset? Arbitrage traders. These institutional players exploit price differences between ETF shares and Bitcoin spot price. If the ETF trades above spot, they short the ETF and buy Bitcoin. If it trades below, they buy the ETF and sell Bitcoin. This keeps the prices aligned, but the process has nothing to do with organic crypto adoption. In fact, most of the volume in Bitcoin ETFs is just hedge funds and trading desks playing that spread, moving dollars, not crypto. This liquidity doesn't strengthen the Bitcoin network. It strengthens Wall Street's control over how Bitcoin's price is perceived. Now here's the problem. Retail investors often interpret rising ETF volume as a sign that Bitcoin is gaining momentum. They assume this increased trading means more adoption, more belief, more strength in the ecosystem. But in reality, it's just capital sloshing through a highly engineered system that mirrors crypto, but doesn't live in crypto. And when that capital pulls back, for example, during a macro risk-off event, a regulatory scare, or a shift in institutional allocation, the ETF's liquidity dries up instantly. Unlike decentralized exchanges, which operate 24/7 with transparency and user control, ETFs trade only during market hours. They are subject to circuit breakers, order flow restrictions, and even government-imposed trading halts. In a panic, you might not be able to sell. In a crisis, your ETF could be halted, gated, or priced inaccurately. And worse, because ETFs are not redeemable for actual Bitcoin by retail investors, you're stuck with a paper claim, not a real asset. Even if the fund holds Bitcoin, you can't touch it. This creates a system where price discovery no longer reflects crypto-native activity. Instead, it reflects institutional sentiment, macro hedging strategies, and the short-term views of fund managers. This divergence is already visible in recent ETF trading sessions. Bitcoin prices have moved significantly, not because of on-chain developments or protocol news, but because large ETF holders were rotating risk exposure or rebalancing portfolios. That's not crypto investing. That's traditional finance dressed in crypto colors. And here's the punchline, this distortion is only going to get worse. As ETFs capture more inflows, they start setting the tone for the entire crypto market. Retail investors begin to chase ETF flows. Analysts use ETF activity as a proxy for demand. Projects are just strategy based on institutional narratives. Before long, crypto becomes financialized, reduced to a ticker on a screen, driven by forces completely detached from its original purpose. This doesn't mean ETFs are bad. They're efficient. They open doors for some investors. But they are a mirage if you mistake them for true crypto involvement. Real crypto participation means running a node, understanding how wallets work, taking custody of your assets, and engaging with protocols directly. ETF trading? That's shadow boxing. In the next chapter, we'll dive even deeper into the hidden motives behind the ETF gold rush, and why the institutions promoting them aren't here to empower you, but to monetize you. If you've made it this far, it's because you care about the truth. So do we. That's why at Money Minded, we keep challenging the narratives others won't. Make sure to like, share, and subscribe to stay ahead of the next big shift in finance. Chapter 4: The Hidden Agenda. If you think Wall Street's sudden love affair with Bitcoin is about embracing innovation, think again. The surge in Bitcoin ETF approvals isn't being driven by a newfound respect for crypto's decentralized vision. It's being driven by profit, control, and a very calculated agenda to repackage crypto into a familiar and controllable financial product. Let's follow the money. Why do BlackRock, Fidelity, And other asset giants want to offer Bitcoin ETFs? Is it because they believe in peer-to-peer value transfer? Open financial systems? Individual sovereignty? No. They're in it for management fees, AUM growth, and strategic leverage over a new asset class. ETFs are a cash machine. Every time someone buys or holds an ETF share, the sponsor collects a fee. It may be just 0.25% or 0.5% annually. But when assets under management reach billions, or even trillions, those percentages become pure profit. For traditional finance firms, crypto ETFs are a new product line, not a revolution. They don't need to believe in Bitcoin. They just need to own the distribution channel, offer regulatory protection, and convince retail investors that their version of Bitcoin is safer, easier, and more legitimate than learning how to self-custody. And they're doing it well. Look at the narrative being pushed. You don't need to worry about wallets, private keys, or exchanges. Just buy our ETF and you're part of the future. But in reality, that narrative is the same bait-and-switch finance has used for decades: abstract away complexity, offer convenience, and charge hidden fees while stripping away control. Worse, once enough capital flows through ETFs, these institutions can begin shaping the future of crypto policy behind closed doors. Here's how. Lobbying power. With billions in ETF assets, these firms gain a stronger seat at the regulatory table. They influence how crypto is taxed, how it's classified, and how custodians are governed. Regulatory capture. By becoming the regulated face of crypto, ETF issuers position themselves as gatekeepers. New projects that want exposure may be forced to comply with their standards, which may favor compliance and surveillance over privacy and freedom. Market manipulation. With large ownership stakes and immense trading volume, these firms can move prices subtly, not by pumping or dumping, but by shifting exposure, weighting indexes, or reallocating risk behind the scenes. None of this is theoretical. We've seen it in other markets, commodities, bonds, even tech stocks. The game is always the same: control the flow of money, influence regulation, and dominate distribution. And now, they're doing it with Bitcoin. This isn't decentralization. This is re-centralization through disguise. What's especially dangerous is how silent this takeover is. Most investors don't notice it happening. They're too focused on the price going up, the charts, the influencers praising ETF inflows, and the perceived validation of crypto. But what's being validated here isn't Bitcoin's ideals, it's Wall Street's ability to monetize a movement that was supposed to displace them. Let's also talk about conflicts of interest. Many ETF issuers are also stakeholders in the media. They sponsor research firms, sponsor conferences, and have long-standing relationships with regulators. When they push the ETF narrative, it's not an open discussion, it's a coordinated campaign. And for creators, influencers, and advisors, there's financial incentive to promote ETFs. They're easy to understand, easy to recommend, and they carry less legal risk than telling someone to self-custody crypto. This creates an echo chamber of hype, where legitimate concerns about control, transparency, and decentralization are drowned out by bullish headlines. But here's the truth. You can't institutionalize freedom. Bitcoin was not designed to be a stock. It wasn't built to be held behind a custodian's firewall. It was meant to be sovereign, censorship-resistant, and accessible to anyone, anywhere, without permission. The ETF model doesn't honor that vision. It neutralizes it. And unless we recognize this shift for what it is, a takeover, we risk waking up one day and realizing that the crypto revolution has been sold back to us in the same packaging we once escaped from. Coming up next, conclusion, legitimacy without sovereignty. We'll bring it all together and share what you can do to navigate this new financial landscape wisely. If you're finding value in this perspective, take a moment now to like this video, subscribe to Money Minded, and share it with someone who still thinks ETFs are the future of crypto. Stay tuned. Conclusion, legitimacy without sovereignty. The arrival of Bitcoin ETFs is being hailed as a major victory. Wall Street is finally embracing crypto. The doors to institutional money are wide open. Prices are rising. Mainstream legitimacy is here. But at what cost? Legitimacy without sovereignty is just another illusion. The promise of crypto was never just about price appreciation. It was about freedom from middlemen, from systemic corruption, from opaque financial structures. It was about building a parallel economy, one where you controlled your assets, your identity, and your financial future. ETFs offer none of that. They offer a proxy. A reflection, a piece of paper that tracks the price of a decentralized asset, but strips away everything that makes it truly decentralized. You don't own the coins. You don't hold the keys. You don't participate in the network. You can't audit the chain. You have no sovereignty. What you have is access, not ownership. And that's the trap. Wall Street doesn't need to destroy crypto to win. It just needs to redefine it, slowly, subtly, and profitably. It needs to turn a revolution into a product. A movement into a line item. A tool of empowerment into another instrument of dependence. And it's working. Because many investors, even those who call themselves crypto believers, are now content with exposure instead of control. They've traded custody for convenience. And they're applauding the very institutions that crypto was built to disrupt. But here's the uncomfortable truth, you can't outsource revolution. You can't claim to be part of a decentralized movement while relying entirely on centralized structures. You can't demand financial freedom while letting brokers and custodians manage your access. You can't believe in sovereignty and still be okay with someone else holding the keys to your future. If all of your crypto exposure is in ETFs, you're not in crypto. You're watching it from the glass window of traditional finance. So what can you do? You don't have to reject ETFs completely, they serve a purpose. Especially for passive exposure or portfolio diversification. But don't stop there. Learn how to use a wallet. Learn how to self-custody your Bitcoin or Ethereum. Understand what it means to verify, not just trust. Get involved with real crypto platforms, the ones that still embody the values of transparency, openness, and resilience. Because the real revolution is still happening. It's just not where the spotlight is. It's in open source code. It's in anonymous developers fighting for privacy tools. It's in decentralized communities that don't need permission to innovate. And it's in every investor who chooses to hold their own keys, ask hard questions, and resist the comfort of financial products that offer convenience at the cost of control. That's where the future is. Not in ETFs. But in people are informed, empowered, and unwilling to trade sovereignty for legitimacy. If this message resonates with you, then you're exactly the kind of person we're building Money Minded for. We don't follow hype. We follow truth. And we help you see what others don't want to say. So now it's your turn. Like this video. Share it with someone who needs to hear it. And subscribe to Money Minded, because your financial freedom is too important to leave in someone else's hands.